Hello and welcome to the UBP podcast. My name is Peter Kinsella and I'm Global Head of Foreign Exchange Strategy at UBP. Today we're going to be looking at how recent Italian bond yield increases are going to affect the euro. At its 9th of April meeting, the Eurogroup, which is basically a collection of the Eurozone finance ministers, was supposed to come up with a viable means of assisting member countries with COVID-19 related costs. The countries which have been worst affected by the pandemic, Italy especially, argued forcefully for the costs of the pandemic to be spread among Eurozone nations. These costs relate to outlays for healthcare and income supports for unemployed workers. Northern European creditor nations balked at the idea, fearing that this would lead to an eventual mutualisation of Eurozone debt. The Dutch government was strongly against the idea, likening the proposal to being asked to pay for your neighbour's mortgage. In the event, the Eurogroup agreed on a €100 billion fund to support crisis-hit countries, and pledged to work on a recovery fund to help stimulate the Eurozone economy following the COVID-19 pandemic. The idea is that the European Commission will borrow in the markets on the strength of future budget commitments from Eurozone member states. This is a classic exercise of European-style can kicking. The Northern European states are doing everything in their power to avoid debt burden sharing and are doing just enough to keep the show on the road in the short term. In any case, the Eurogroup meeting ended with much fanfare, but when investors weighed up the actual details, there was little to celebrate and Italian yields rose again. Italian borrowing costs have surged in recent weeks. 10-year Italian bond yields have risen to levels of around 2%, from levels of below 1% in February. This is a large move, and it has to be seen in context. The European Central Bank has restarted its QE programme, and it is estimated that around 40% of current ECB bond purchases are of Italian bonds. The ECB normally buys bonds in line with its capital key, which means that only 17% of ECB bond purchases should be focused on Italian debt. It doesn't take a genius to figure out that were it not for ECB bond purchases, Italian yields would be a lot higher. The ECB is not active in the credit default swap market, also known as the CDS market. So CDS prices now give a better idea of market perceptions of Italian creditworthiness. Italian CDS spreads have widened significantly in recent weeks and now trade at levels above 250 basis points. These levels indicate that markets give around a 20% probability of an Italian default over the next 5 years. This is serious stuff, and it is justified. Italy entered the current crisis with an elevated debt to GDP profile of around 136%, a moribund economy, and an increasingly polarised political setup. Assuming a GDP contraction of around 10% in 2020 and increased borrowing in the region of 10 to 20% in the coming 2 years, Italy could easily end up with a debt to GDP ratio in the region of 160% or even possibly 170%. These are enormous sums, and investors are right to be worried about them. Previously, investors looked past Italy's large debt to GDP ratio because Italy always illustrated a primary surplus, meaning that Italy posted a fiscal surplus before interest payments on its debt were made. The assumption was that as long as Italy managed to pursue this policy and the ECB maintained lower yields, then investors had few worries. The large decline in tax revenues as a result of COVID-19 and the associated huge increase in fiscal outlays means that the days of Italian primary surpluses are long gone. ECB bond purchases will not change this new dynamic, and it will be interesting to see whether the Italian Debt Management Agency is able to roll over expiring debt in a seamless manner over the coming quarters. Our best guess is that the European Council, which again is a collection of European prime ministers, will come to an agreement to raise the European Stability Mechanism, also known as the ESM, to raise the ESM's borrowing limit, which is currently around €500 billion, and also to pledge a certain percentage of the European Commission's budget towards COVID-19 related spending. This is about as much as we can hope for in the short term, and indeed it may be enough to prevent aggressive Italian yield increases in the short term. However, our worry is that when the global economy recovers in the third quarter, we should expect another bout of yield increases as investors have the time to reassess Italian debt dynamics. At a minimum, the potential for political confrontation and challenging debt dynamics suggests that Italian yields will trade at structurally higher levels, reflecting investor demand for higher risk premia on Italian debt. The ECB in recent weeks is rumoured to have asked Brussels to come up with a bad bank solution for the Eurozone. It is now unclear whether this scheme is intended for Eurozone retail banks to shed some of their non-performing assets, or whether it is a means of getting some of the ECB sovereign debt holdings off its books. If it is the latter, then investors have every reason to worry. This is unlikely though. The ECB hasn't been effectively monetizing Greek debt, foregoing interest payments and allowing extension of debt profiles for years, and it will do whatever it takes to keep the show on the road as far as Italy is concerned. The greater concern for Italy is now political. Italy was once one of the most Europhile countries in the EU, but now is one of the most Eurosceptic countries, and with good reason. Italian people feel that Europe has done little to help regarding the recent COVID-19 pandemic, and over the longer term, Europe has not helped Italy regarding the long-standing migrant crisis. Austerity policies have had seriously negative effects on Italy over the last decade, and consequently, Eurosceptic parties have achieved notable electoral successes. This doesn't mean that Italy will pull the plug on Eurozone membership, but it does mean that Italy could consider a more robust stance regarding its relations with the EU. While deficit financing is prohibited according to the ECB's charter, there is no mention of a ban on helicopter money policies. And indeed, this is one potential sort of area where we think there is scope for confrontation over the coming months and years. One of the lessons which should have been learned, at least at an EU level, is to show greater flexibility with members who have significant domestic demands. The failure to placate David Cameron's demands on migration ended up with Brexit and the loss of the EU's second largest budget contributor. A similar recognition of the Italian difficulties in the current period could prevent a bad situation becoming a lot worse. Over the longer term, there are a number of economic considerations which have to be made regarding Italy. Italy is the Eurozone's second largest manufacturing economy after Germany. While German manufacturing tends to be relatively high-end, think of the auto sector and indeed precision engineering, Italian manufacturing focuses on textiles and some industrial goods. The Italian manufacturing sector has contracted significantly since Italy joined the euro, due to aggressive competition from German and foreign firms. Clearly, Italy no longer has the devaluation option, meaning that it struggled to compete on pricing. The problem for Italy now is that a departure from the euro would not necessarily lead to an immediate manufacturing renaissance, because its main export competitors are China and to a lesser extent Turkey. The real focus, when the current pandemic passes, should be on improving the structure of the Italian economy. This is much easier said than done, but if Italy is to have any chance, it must be done. Italy has a population which is similar in size to the UK's, yet Italy does not have a single university in the top 100 in the world. For comparison, the UK has 18 universities in the top 100. Remember, Italy is the country that gave Europe the Renaissance. And in the absence of a decent education or third level sector, Italy is going to struggle to have a functioning tech sector, nor indeed even an advanced medical sector. Consequently, Italy really needs to up its game in this sector. Likewise, the Italian legal system is also a mess. It takes over 9 years for civil cases to come to an end. This is just the tip of the iceberg. But it should be clear that unless serious structural reforms are undertaken, Italy will continue to be dogged by a combination of low growth and persistent debt crisis. This is a shame, because it doesn't have to be like this. The implications for the euro are quite clear. If the situation deteriorates significantly and risk premium on Italian and indeed peripheral eurozone debt increases significantly, this will obviously place significant pressure on the euro, particularly to the downside. And this is where the risks lie for the euro over the coming months. Our base case scenario is indeed for euro dollar to rise over the medium term, reflecting a decrease in basic trade weighted dollar. And that's basically a reflection of our expectation of certainly the cheap financing costs for the dollar, but over the longer term, eventual dollar weakness consistent with the Fed's easing policies. The risk to our forecast, however, is on the downside, simply reflecting those recent dynamics with peripheral eurozone debt. Thanks for listening.